everyone, welcome back to my channel. So today's video will cover Q2 fundamentals for a few companies that reported earnings last week. So I definitely wanted to go ahead and make this video for anyone who didn't have time to maybe check the numbers. All of the stocks that I'll cover in this video are fairly popular and ones that tend to have a lot of momentum. But let's go ahead and jump right into it. As you can see, I have Visa here pulled up under the Analyze tab, and I'm looking under the fundamentals here in Thinkorswim. So I'm going to go ahead and scroll past, and we're going to take a look at the numbers. And y'all have seen me do this tons of times before, so I'm not going to go into every single thing that you see here, but I will give specific detail on a few things so that you have at least a heads up on what to expect. And also you can take a look back at what happened within Q2. Alright, so when we go ahead and take a look at share values and we're looking at the EPS, we can see currently that it's at $8.68. And then when we take a look at that, when we look at the reportings that they have for Q2, it was at $2.69. Now it also lets us know that they are up 13.84% quarter over quarter. And for me, this displays consistent growth trajectory. Now when we take a look at their free cash flow, we can see it's at $9.39, and this exceeds the EPS, which indicates strong operating leverage. And in combination with that, we see that it's at $16.11 for the sales per share, and this also indicates that they're steady quarter over quarter. And that's pretty much proven when we take a look at Q2 for 2024, Q3 for 2024, and then of course Q4 as well. These numbers are pretty much staying consistently the same. The return on equity for Q2 of 2025 of this year is at 54.99. So this then lets us know that they're extremely efficient at generating shareholder value. Now the net profit margin is also at 51.82, which indicates that that's pretty high for any sector. And then their gross profit margin is at 97.79, and that's a near perfect operational margin efficiency if you ask me. So as far as being financially stable, we do show that the numbers indicate that there is significant room over financial obligations, meaning that it is manageable and obviously is pretty stable. Now when we take a look at the PE ratio down here, we can see that the valuation metrics show us that it's at a 34.65, which is slightly above its 5-year average of 33.83, which further shows that it's just pricing in consistent performance. Along with that, we see the price to book value ratio at 18.13. Now this is elevated, but it is typical for high margin payment processors like Visa. I will mention that the dividend yield at a 0.66% is modest, with a decently steady dividend growth of 22.32. So that's also going to show the reflection of the growth rates when we take a look here. We see the current revenue is at 11.38. It's slightly below past averages, but still pretty strong relative to the previous years. The EPS is below its average at 9.62, but as mentioned, the dividends per share is currently at 13.46, which is pretty consistent with securing long-term capital return. So all in all, Visa remains highly profitable. It's a well-capitalized company, of course, and we do see that they have elite margins and shareholder return consistency. But it is important to note that while growth rates are tapering slightly, the fundamentals remain, for the most part, in my opinion, top tier, making Visa a long-term compounder in most portfolios. So I don't think anybody that's holding Visa is upset at these numbers. But let me go ahead and scroll down real quick so I can show y'all a full breakdown of the information. So I just want to quickly look at what's changed. I'm not going to read this verbatim, but I will just give a quick synopsis of it. It's basically saying that Visa has exceeded the revenue and earnings expectations. And for Q3, as consumer spending is pretty much staying resilient more than necessarily anticipated. Of course, the revenue expanded 14% YOY and the earnings per share rose by 23%. Now, processed transactions were up by 10% and payment volume also climbed to 9% as well. And that's just displaying acceleration from the prior quarter. So yeah, that's everything on Visa. Let me go ahead and pull up PayPal. Okay, so PayPal reported earnings on July 29th as well. And then of course we're going to go ahead and scroll down and take a look at the numbers. Now based on the data shown, some key highlights that I do want to pinpoint. So if we look at the earnings per share, it's currently at $3.84. So it's holding pretty steady. And when we take a look at Q2, of course we see it at $1.29. Now the free cash flow is reported at 98 cents. And then when we take a look at it currently, it's $3.83, which nearly matches the EPS. Now, as that relates to cash flow per share, it's important to note that we see it reported currently at $5.58, and that's in comparison to $1.86 for Q2. So that gives us full understanding that PayPal is comfortably above free cash flow, showing good internal operations. Now, in regards to profitability, when we look at the return on equity, it was reported at 24.93, and it's slightly down from Q1, but still pretty solid. The net profit margin is also a little bit lower than what it was from Q1 to Q2 at 15.21, which is actually signaling compressed margins. Now, in reference to the gross profit margin, we see it at 41.39, which is just slightly below what it was for Q1 at 42.58. So, of course, it's trending downward from Q1. Now, when we take a look at the valuation metrics, we can see the PE ratio is currently at 15.92, and this is well below the 5-year average at 31.91. And this is suggesting that PayPal may be undervalued based on historical norms. So it kind of goes without saying when we take a look at the price to cash flow ratio here, this 9.39 is also below the 5-year average of 17.76. And then the price to book ratio is at 3.53. We don't see the 5-year average, but that's pretty typical for a tech financial hybrid like PayPal. So with this in mind, we do see relatively high numbers for some categories, and of course this is consistent with its fintech structure. So most of the numbers we see are pretty steady and manageable. So when we take a look at the growth rates, we do see some regression here. The revenue is currently declining at 4.07 compared to a 3-year average at 6.96. The net income is also sharply down at 5.43 versus the 3-year average of 31.53. And that also goes along with the EPS as well. When we look at the current, it's at 12.8, which is extremely far below the 3-year average at 38.65. Now, are these all completely red flags in the company? Not 100%. I will say the main takeaway is that PayPal appears fundamentally stable in some areas, but it's experiencing margin compression and slower growth. The stock is currently trading at a reasonable price compared to its historical valuation multiples, which may attract value-focused investors, especially those watching for a reversal or turnaround in profitability trends. So if you're one to take a look at those numbers and you kind of use that to base your leaps on, or even if you're doing like long-term swing trades, this may be a company that you may decide is a good time to buy if you anticipate the stock rising in the near future. So that's everything for PayPal. I'm going to go ahead and pull up Meta. So we're going to take a look at Facebook. And for this analysis, I'm actually not going to go through every single one of these numbers because for the most part, y'all can kind of see what's going on. I'm just going to more so focus on the growth rates, and then also I'm going to show you what's changed. So when we go ahead and scroll down just a bit, we can see that the current revenue was at 19.37, and that's up from the 3-year average at 14.4. The net income and EPS are also up as well. So those are also, of course, good signs for the company's growth. Now, when we go ahead and take a look at what's changed, we can see here they give us a breakdown of what's happened in recent years. They tell us that there's been a lack of consistency lately, and the returns for the stock were 23% in 2021 and a negative 64% in 2022. However, there was a major turnaround in 2023 at 194%, but in 2024 it fell to 66%. So from there, they also tell us a comparison between Meta and the S&P 500, and it tells us that it was at 27% in 2021 with a negative of 19% in 2022, and pretty stagnant numbers for the year 2023 and 2024. And this is indicating that Meta has underperformed the S&P 500 in the early years of 2021 and 2022. So when we process this information, we basically can draw the conclusion that Meta has not been a consistent stock as far as stability, but that doesn't mean it's not a quality company. It just means that the metrics are not consistent across the board. So all in all, it's basically like a wild card. So you can choose to invest in this company if you see fit, or you can also choose to be a little bit more conservative within your investment and steer clear. It's really just your choice as an investor. Now, along with Meta reporting earnings on July 30th, QCOM also reported earnings as well, so we'll pull the numbers up here. Again, I'm going to scroll past this for the most part as far as analyzing every single line item of these numbers, and we're going to go ahead and take a look at what's changed. Now, we can see here it's telling us that QCOM posted a better than expected set of earnings, and the revenue rose almost 10% compared to last year at $10.37 billion, with the adjusted earnings at $2.80 per share. They then go on to tell us the strong performance and what was the driving factor of it. So just taking a look at the numbers and of course the growth rates, we do see again there is some stagnation within this company. However, the numbers have improved from what we see currently within the past few quarters. The revenue was fairly moderate along with net income and the EPS as well, because we can see that the 3-year average was in the negative for some of these metrics. So again, it doesn't necessarily mean the company is bad or that it's not performing at a high rate. It just means that sometimes there are pullbacks due to stock market catalysts, maybe even the news dictating that there are times where companies do have those moments where they will have a decline in the stock's value, and that can be attributed to a number of different things. So with that, I'm going to go ahead and pull up Apple. Now, Apple reported earnings on July 31st, so I'm going to go ahead and scroll past, and we're going to take a look at the growth rates. Now, we definitely see a decline in the numbers here, especially in comparison to the 3-year average. And when we go ahead and take a look at what's changed, we can see that Apple posted a better than expected set of earning results prior. However, we see the revenue grew 9.6% YOY to $94.04 billion, while earnings came in at $1.57 per share. Now, of course, we know that the driving factor in this is going to be the iPhone 16 sales and revenue from services. Now, one of the major things to pinpoint on why we see the numbers decline so drastically is that Apple is, of course, one of the companies that's affected by the tariff-related cost. So they incurred expenses at about $800 million in June, and of course, we also see it projected to be at $1.1 billion in September. So these numbers are definitely something to keep in mind in the coming months. But we'll go ahead and take a look at Amazon because they also reported earnings on July 31st as well. So I'll scroll down past the numbers. We're going to take a look at the growth rates. We can see a slight decline from the 3-year average, as well as the net income and the earnings per share also seeing a bit of a dip as well. However, the current average is up from the 5-year average in both categories. So that draws the question of what has changed. So when we take a look here, they tell us that the changes in Amazon stock over the recent years have been far from consistent, which is completely true. They then provide a breakdown of the numbers from 2021 up until 2024, and we can clearly see that it's been pretty up and down, everything from 2% to a negative 50%, 81% to 44%. Now, similarly to Meta, they also compare the returns for Amazon to the S&P 500. They provide a full breakdown of the numbers from 2021 up to 2024, and it also displays that Amazon did underperform the S&P in those years of 2021 and 2022 in comparison. But when we take a look at this year, there has been a 9% YOY increase, a 17% gain in AWS segment, and a 5% increase in international sales. So their bottom line has increased, which does offer a positive sentiment for a lot of investors. Because when net sales increase, the operating income tends to follow. So while the numbers aren't perfect, they are showing at least signs of improvement. So that's everything for Amazon. Let me go ahead and pull up Coinbase. We'll scroll down to the growth rates as well. Now, the main two things I do want to talk about when it comes to Coinbase are going to be the net income and the EPS. We see that the numbers are down, and they're down in both categories in comparison to the 3-year and the 5-year percentages. But when we take a look at the EPS for the quarter for Q2 of this year, we can see that it's actually at $5.14, which is a huge jump from Q1's reporting of just 24 cents. And then in addition to that, we do see that the current reporting of the return on equity is at 50.66 in comparison to Q1 where it was only at 2.53. So what does that mean for the valuation? So of course that means the PE ratio has increased as well, and we can see it currently at 33.96 in comparison to that 5-year at 8.44. So there's so many things that dictate whether the stock is improving in some areas while facing challenges in others. And as I've mentioned in prior videos, there's so many different catalysts as well that tie into why these numbers look the way they do. All of that ties into how the economy shapes the way the market is moving, or in some cases remaining stagnant. Now the last stock I do want to pull up is going to be XOM Mobile. So we're going to go ahead and take a look at the numbers here. Now Exxon reported earnings on August 1st. When we take a look at the growth rates, the revenue is down at 2.2 in comparison to the 3-year and the 5-year average, along with the net income and EPS. But I will say that the dividends per share has increased at 4.3 in comparison to the 3-year average at 3.49. Now, when we take a look at the snapshot of what's changed, they tell us about the mixed fourth quarter results of 2024 that yielded stronger than anticipated earnings, and it surpassed the market consensus. And the major catalyst behind this was higher oil and gas production, which offset lower oil prices and weaker refining margins. But the total revenue for the quarter was at $83.4 billion, falling short of the anticipated $86.3 billion. But the good news, on the other hand, was that Exxon achieved its highest production in over a decade, reaching 4.3 million oil equivalent barrels per day. And then the final highlight to go over is that the company extended its $20 billion annual share repurchase program through 2026. So this demonstrates that confidence and, of course, cash generation. Yet and still, the free cash flow did decrease by 29.2% to $8 billion YOY. However, we're going to focus on the positive in this case with the production of oil. And then, of course, we see the numbers also surpassing market consensus. So for the most part, all in all, the main takeaway is that Visa remains a highly profitable company with elite margins. They also have really good shareholder return consistency, meaning people tend to buy and hold the stock for a very long time. So the fundamentals remain top tier, making Visa a long-term compounder in most portfolios. PayPal appears fundamentally stable in some areas, but it's experiencing margin compression and slower growth. Now, Meta and Apple seem to have a little bit of instability when it comes to long-term valuation of the fundamentals, but again, still very reputable companies. QCOM, Amazon, and Coinbase are still considered growth stocks in a lot of people's eyes, so we of course will see the numbers be a little bit up and down with those companies. And then last but not least, ExxonMobil, of course, a company with pretty strong fundamentals. So shareholders always tend to express a great deal of confidence within buying and holding this stock. So yeah, y'all, for the most part, that's all I really wanted to cover. Just wanted to give a quick little brief breakdown for anyone who didn't get a chance to analyze the numbers this past week, and I hope this was helpful. So yeah, y'all, that'll pretty much do it for this video. If you found any of this information to be beneficial, feel free to leave me a comment down below. As always, I thank y'all so much for watching, and of course, I'll see y'all in my next one.